Three warning signs that mean the death of a dividend stock. Income stocks can plunge 50% or more when a dividend is cut, and you just can't ignore the warning signs. I'm going to reveal what I look for in dividend investing and how it can save you thousands of dollars. In fact, I've found one $300 billion company that almost everyone loves but is on the verge of cutting its dividend. We're talking dividend investing today on Let's Talk Money. Joseph Hogue here with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here today. If you're not part of that community yet, just click on that little red subscribe button. It's free and you'll never miss an episode. Now, few events destroy as much value for stocks as a dividend cut. Besides the loss in that cash payment that investors come to count on, a dividend cut signals big problems at a company and investors always rush to the exits. We've seen this just in the last year with cuts at both General Electric and Teva, and their stock prices absolutely got crushed afterwards. GE shares were already down 24% to its September earnings announcement when that dividend was cut in half, something the company had only done twice in more than 100 years. Shares have fallen by more than 50% just since that time. For Teva Pharmaceuticals, shares had already been falling for a full year when rumors started circling that the dividend would have to be cut. The price plunged just on the rumor and was confirmed less than a week later, with the price falling 62% to last year's low. Now, two facts should be painfully obvious here. First is that you absolutely must see a dividend cut coming before it happens and get out. I've talked to a lot of investors that got trapped by a stock. They saw it lose 20 or 30% and are thinking it just can't get any worse before a dividend cut. But it can always get worse. Second here is that there are warning signs to a dividend cut. The market saw it coming in Teva's case, and there are fundamentals you can watch for to sell your investment. Now I'm going to reveal three warning signs of a dividend cut, three clues I found when studying stocks that have cut their cash payout. In fact, I found a hugely popular dividend stock that is flashing all three of these red all over. More than 100 ETFs hold this stock, including the largest S&P 500 market funds, and it's in almost every retirement portfolio. The stock pays a 6% dividend yield, but that isn't going to last, and the bottom could drop out at any time. Now, I'll walk you through the warning signs first, and then we'll look at that stock and why I think you need to get out now. First though, I'm always looking for new investing ideas in dividend stocks, so scroll down and share in the comments, what's your favorite dividend stock right now? What dividend yielding stocks should we look at, and which ones do you have questions about? So scroll down and leave that in the comments. Now, I'm going to be honest with you. These three fundamentals are going to involve some deep financial analysis. We're going to be looking at the financial statements of a company just as an analyst would. If you're not ready to do that, then you're not ready to invest in individual stocks. Put your money in an index fund and just don't worry about it. If you are ready to do a little bit of work, just less than a half hour of stock analysis to save yourself maybe 50% when you find a company that's about to cut that dividend, then stick with me and I'll show you how it's done. So let's get to that first warning sign, and this is probably the single biggest factor in a dividend cut. Now, a company has three primary cash needs for its free cash: reinvest in the business, pay off debt, or return cash to investors for those that pay a dividend. Now, anything left over after expenses and normal operations goes to one of these three needs. When times are good, it can do all three. Now, unfortunately, also when times are good, companies start thinking they can take on mountains of debt to acquire competitors. When either sales after those acquisitions don't live up to expectations or the economy just takes a hit, the company is left scrambling to make debt payments. For example, Teva fueled itself on acquiring other drug makers for years. It neglected its own drug development, and because rates were at historic lows, just refilled the pipeline by buying other companies. In 2016, it funded its $40 billion acquisition of Actavis with $25 billion in debt, just ballooning the amount it owed. Now, interest expense it owed each year tripled from $270 million to $875 million within a year. When generic drug makers found they couldn't keep up the pace of price increases and competition just started eroding those sales, Teva was in trouble. Net income plunged to a negative $16 billion last year, and there was just no way out but to conserve cash by slicing that dividend. Checking the debt load on your stocks isn't that hard. First, you want to check out the statement of cash flows under cash flow from financing. Now, this is going to show you if the company has been repaying debt or has added a bunch lately. Of course, if they've made any big headline acquisitions, then you can bet most of it was paid for with debt. Now, just putting on more debt isn't necessarily a problem and doesn't mean a company is going to be in trouble. You also want to look at these next two factors to check if a company can support that debt. Now that first warning sign is a big one for this major blue chip stock that I found. I'm going to run through these other two fundamentals, but when I reveal it at the end of the video, a lot of people are going to be running to their online broker. So next, let's look at a company's revenue growth and cash flow from operations. Now revenue is posted on that income statement and operational cash flow is back on that statement of cash flows. Again, a lot of companies are going to think that making a big acquisition is going to fix their sales problem. They might even be losing sales but think that tying another boat onto their sinking ship, that's suddenly going to get them both to float. Teva had seen sales flat for 2 years and even fell by $620 million in 2015. That $40 billion acquisition helped them make another $2 billion in 2016, but that huge cost with extra expenses and interest payments. It doesn't take a financial nerd like myself to understand that buying another company isn't going to fix your broken one. If you own shares in a company that's losing sales and management can't do anything about it, the last thing you want them to do is try covering that up by acquiring other companies. They couldn't manage one company, how the hell are they going to manage it plus the acquisition? Now for operational cash flow, and this is really the king of all stock numbers, we go back to that statement of cash flows. Now any analyst is going to spend their first year losing their ever-loving mind looking at the cash flow statement. It's here where we spend almost all of our time really. Net income and that income statement is really easily manipulated by management. You recognize some sales early that won't be delivered for a while, or maybe you hold off on some of those expenses and boom, you've got higher profits. But with cash, you just can't do that. The cash flow statement is a pure view of the cash generating power of that company. So we look at that net cash provided by operations and what? Lo and behold, even though Teva reported sales growth in 2016 and everything was supposedly glorious, it made less cash than the year before by $317 million. Now you're looking at revenue stagnate and cash flow dry up, but the company has more bills to pay with this mountain of debt. That cash had to come from somewhere. So our last dividend warning sign is a high payout ratio. Now the payout ratio is just the percentage of profits paid out to investors as the dividend. You can take the quarterly dividend times 4 and divide it by earnings per share, or just look where it says dividend paid on the cash flow statement. But first, here's a fun little quiz. If a company is paying out most of its profits as a dividend and those profits fall, what's going to happen to that dividend? Yeah, that dividend's going bye-bye. Now, in truth, a company can support its dividend even if profits fall for a little bit. If it has some cash set aside and management thinks that those weak profits are only temporary, but those are two very big ifs. So the question becomes, what is a high payout ratio? How much of profits can a company pay out and still be safe? Now that's going to vary by industry. Some industries with super safe sales and earnings like utilities companies pay out as much as 2/3 of their profits and rarely have a problem. Other companies might have trouble supporting a dividend that's even half of their net income. The first thing you want to do is compare the company's payout ratio with others in its own industry. Now Professor Damodaran of the Stern School puts out a lot of great data including the average dividend payout ratio by industry. So you can see if a company has an abnormally high payout ratio compared to its peers. You can also just use this along with what we saw in the revenue and cash flows and make a judgment call. If the company is walking a tightrope with a high payout ratio, then it better have rock solid earnings growth. So now that we know the dividend warning signs, it's time to look at that company I found that could be an imminent danger. This $236 billion company is held by almost every large market fund. Between Vanguard, BlackRock iShares, and State Street, these 3 fund providers own $42 billion in shares. Now, investors have jumped into the shares because of that 6% dividend yield, even as the price has plunged 25% since 2016. The company is AT&T, and I know a lot of you are big believers in Ma Bell. I used to be an investor myself until just recently, but this one could be in big trouble. Now, AT&T dominates the wireless market in the US and is a favorite dividend stock of a lot of investors. It's consistently increased that dividend for decades, and that creates a lot of loyalty. But before you click away, hear me out, because all 3 of these dividend warning signs are just flashing red. The company is already no stranger to debt, with its amount owed surging $50 billion just over the last 3 years to $126 billion. That amount is on top of $177 billion in pension and other liabilities, and it's about to jump into another $55 billion in debt with the approved Time Warner acquisition. Now, AT&T has some cash laying around and is cash flow positive, but interest expense is already $6.3 billion a year and set to increase. So we pop on over to the income statement to look at revenue growth. Now, for companies that do a lot of acquisitions, buying other companies to fuel that growth, this can be a little bit hard to spot. We saw that AT&T has booked some decent revenue growth over the last several years, but these are all on acquisitions. The years where it didn't buy another company, it didn't do so well. In fact, sales fell $3.2 billion last year. Even worse though, and this is something we didn't talk about, is that operating income, so what's left of sales after paying expenses, fell at an even faster pace. Now, the operating margin, or the operating income divided by sales, that's basic profitability of a company, has fallen a full percent to 15% over the last year. So not only is that company facing weaker sales, but it's less profitable on those sales. And cash flows aren't any better. The company was able to make its earnings look better with a one-time tax benefit, but that's not real cash. Actual cash from the business dropped $193 million last year and has become even more volatile. Now, if we look at the payout ratio, so we take that 50-cent dividend times 4 for an annual payout of $2 a share and divide that by the $3.24 in per share earnings over the last year, we see that AT&T is paying a 62% payout ratio on its profits. Now, that's not ridiculously high for a telecom company, but if you look at how much that $12 billion dividend payment is compared to free cash flow of $18 billion, that's 2/3 committed to the payout. Now, the payout ratio isn't dangerous yet, but it's close, and everything has to go right after they put on that new debt. That means all their telecom and their TV business and that new media business all has to be firing on all cylinders just to keep that cash flow safe. And speaking of that new media business it bought with the Time Warner acquisition, that's a completely new business model. Media and content isn't exactly a cash flow business like telecom. So both businesses require a lot of capital spending, but the payoff in media is much less certain, and competition is extremely high. Now, management is going to need that cash generated by the telecom side to reinvest in the media. Even if the dividend isn't cut, that 6% dividend yield just isn't realistic for a conglomerate company working through all those integration costs. Now, I'm not saying the company is cutting its dividend tomorrow, and it might even scrape by without a cut, but what's the upside on this thing? You might get 8% total return a year, including the dividend, but that's at a risk of losing half the stock price if that dividend is cut. The risk-reward trade-off on AT&T is just all screwed up. Now, there are other dividend stocks out there, some very good ones with good fundamentals. If I'm wrong, you're still making money on another stock. If I'm right, you're going to be naming your firstborn after me, right? You better too. We're here Mondays and Wednesdays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and we'll answer it in the next video.